Right, good to go.
Hello, everyone, and welcome to our third episode of our investment mastermind this year. This is our Q3 episode, and I'm joined again, as always, by Manish Kataria from Invest Like a Pro and Adam Lawrence as well, who writes the Sunday supplement. So, welcome both, welcome back. Be great to hear your thoughts on what's going on in the markets.
Plenty to say this time round, I think, Rod, to be honest, and thank you for having us back again, of course.
So, do you want to get started then, Adam?
I'm happy to, yeah, absolutely. It's been an interesting few months, obviously. We've sort of been probably distracted more than anything by an election that really hasn't made that much difference to the path of growth in the economy as yet or anything else. So the UK has been being talked down for a long time. I think in many ways I started theorising about 6-7 months ago, maybe a little bit longer, that we probably hit a relative rock bottom, to be honest, in terms of yields were right up, money had got expensive. Everybody was talking down. The unemployment was going to go up. Productivity's been terrible, which is true, of course. But, we kind of fumbled our way. This is probably being generous, fumbled our way out of the European Union and all the rest of it. And without something going wrong, we probably had a pretty good base to start from. And then we printed, 0.7% growth for Q1, 0.6 for Q2. Q3 probably looks a little bit more subdued than that. And some of that growth is on the back of having got inflation right back under control, where we are exactly on that, differs slightly, but, slightly ahead of target is probably what we'd say for the next 12 months as a fair estimate. And so you end up with an economy that is creating a few jobs, that isn't looking too bad, that's got real terms wage growth. And, we've been there for about the last 9 to 12 months now. And all this, of course, I'm generally looking at this from the lens of property and what it means for tenancies and property prices and all the rest of it. But in the broader economy, you think, well, not too bad. And we haven't had sort of meteoric, in fact, we've had pretty weak stock market performance for the last 25 years, really, in the UK. And that probably gives us a good platform to grow from. And that's why we were able to sort of blow through 8,000 on the FTSE without any signs of really slowing down too much until the American counterparts looked like they were catching a bit of a cold. And of course, they've got a pretty big election coming up with a pretty stark choice between two people who, regardless of your opinion on either of them, are going to have quite different approaches to what the US economy is going to do. So I think we've ended up in the UK almost whereby, nearly by default, things don't look great in France. European elections didn't look very good in terms of investors don't really like extremism, whether it's on the far right or the far left. And by default, we've ended up with a relatively centrist government getting elected in the UK, and we look like a good, solid investment destination. And if they can unwind some of the more stupid parts of Brexit, then perhaps there's lots of growth on the table that's, how much I hate that phrase, but we say it every time, low-hanging fruit, really, Rod. That's where I'm at the moment with all of that.
Brilliant. So, Manish, a lot of chat there about the economy. We talked a little bit about the markets, but how does that translate going into the markets then, would you say?
Yeah, so I agree with Adam in terms of, we've got a fairly benign, backdrop to the economy, right? So when we're looking at the economy, and when I talk about the economy as far as the stock market is concerned, it's really about the US economy. That drives global stock markets. What happens in the UK is pretty irrelevant as far as, the impact on the global stock markets are concerned, even to an extent, the UK stock markets, because, again, that's driven by global events. And if you look at the US economy, it's all very benign. It's what we call in the industry, we call it a Goldilocks economy. So it's, not too hot and, not too cold. And it's just about right for interest rates to be kind of, a bit of a stable outlook. I think we've definitely peaked as far as interest rates are concerned in the US. And, the base cases will have a gentle decline. And all the sort of, ingredients in the US economy is that, the unemployment rate is fairly low, GDP is plodding along, not too hot, not too cold. And equities love that because, it means that interest rates aren't going to be cut significantly. They're not going to be raised significantly. A couple of weeks ago, we had a bit of a scare because some of the traders put 2 and 2 together and got 16. And they saw a couple of the economic releases and thought, okay, we've got a recession coming up in the US. And since then, we've had some really positive data come out. So I think overall, it's a good backdrop for both, global equities and for real estate in general.
And I mean, last quarter, it was back in April now that we all had our picks there. And it was very sort of value orientated, a lot of UK or FTSE 250. Adam came on with a dimensional UK value as well. And all of those choices that we made are doing really well when looking back now versus April. So they're all doing pretty good. So maybe that's a sign of where things were. So I'm interested to see where you think now things are going. Is there still more growth to come in UK and value? Is there is, like you say, the US, it's just right. So is that going to give us the growth that we need, or is there still gains to be had there, or is it somewhere else? So yeah, interested to hear. So shall we get on with the picks? And does anyone want to go first?
I don't mind going if you like, Rod, because I don't normally go first, I don't think. So I'm happy to. And I think, looking back at the last episode, as you did do, I think we were all very much on the same hymn sheet. And we were betting on the UK to be undervalued in one way or another. And a few times when we've done this over the years, I have gone to the bond markets because I do spend quite a lot of time looking at them. I do have some fairly strong convictions. Sometimes it's maybe a bit of gut feel more than anything super technical. But if we went back to the one with these we did a year ago, I know that I actually made the same pick as I'm making today. But that didn't put me off because I thought, you know what? Sometimes when you think you're right, you need to move and perhaps press up the stake that you've already got. So I was pretty pleased to it probably says more about the date of that episode than my epic timing, but I recommended buying the 30-year gilt, or certainly I was talking about doing that myself when the yield was up at 5.1%, which was great. And then in the interim, we had a real wax in the gilts around Christmas time, and actually the yield dipped under 4%. So there was a potentially big profit there if I decided to close that one out. But the point is, I still think this is trading at too generous a level. I think the price is too low. It's about 4.46 or something as we're recording this. I can't fathom why the 30-year should be at this sort of value in the United Kingdom. And the way I'm justifying, I'm going to tell you a little story instead of trying to be too technical about it, right? I think we all forgot there was interest rates to an extent. I mean, don't get me wrong, boring, sensible people like us were talking about when rates would go up. What are you going to do when rates go up? I dare say you could go back to our social media posts, Rod, and there'd be plenty of those over the years. I remember in 2015 putting my hand up in a room when people said, what's the biggest risk to property investors? And I keenly shot my hand up and said, it's the interest rate. And people looked at me like I was mad. And I said, well, but one day it's going to cause you a problem just because it's cheap right now. And I was very keen to make that point because that was actually in Cambridge. And obviously Cambridge properties, very low yielding stuff. So it could easily change, pretty viable strategy into an unviable one fairly quickly. Unless you were relying on huge lumps of cash and no leverage, of course, which is, of course, the way some people do it, but it doesn't help magnify returns apart from anything else. So I think we're still there, and I think we've gone too far the other way. Like we do sometimes, the pendulum has swung. 30 years is a hugely long time to be considering, and I can't see the average rate in the UK over the next 30 years looking anything like 4.46%. I really can't. I think this should be 1% lower. than it is today, which is, 28 odd % or something of the return. It's a long way out of the money for me. Now, it's not going to be humongously volatile. He says, looking at a graph over the last 12 months that's been humongously volatile, but I don't think it will be. But I think at the moment, we're not pricing in that once the inflation gremlins have really worked their way through the system, then really what we're looking at is an economy that in the next 10 years, in my view, is going to trend back down more towards a 2.5%, maybe even 2% base rate if things calm down as I'm expecting them to. And apart from anything else, I think that's going to be the case because I don't see a way out of the tax trap at the moment in terms of taxes somewhere along the line are going to have to go up significantly if we want more money in infrastructure, which we do and we should have. And we should, frankly, just as an aside, change the fiscal rules so that we can do that, in my opinion. But we're going to have more investment in healthcare and social care, and we're going to have ultimately many, many, many more old people apart from anything else. And productivity is going to struggle on that basis because it's all very well if you kick the pension can down the road. And we've already done our legislating for that probably, and we're pretty painfully slow, really, in the UK. But it's going to be hard to crank up productivity if either because of the paucity of pensions or inflation or just changing the rules, you're going to force lots and lots of older workers back into the marketplace or to stay in the marketplace longer than they would otherwise want to. So lower productivity, struggling with growth, we tend back towards low interest rates in order to try and stimulate that a bit. I'm not saying we're back to 0.5% days or lower. If we are, we know we're in trouble. But if we're going to tend downwards on the 3-month money, I think we're just going to trend downwards. And the further we go out, as soon as this yield curve finally sorts itself out, and yeah, it might take another year or so, I don't know. But I think we're going to see a big adjustment in this downwards. And I'd be targeting this price being more at 3.5%. And that's why I wanted to act again. So that's my stories for the quarter.
Okay, interesting. So I've got a couple of questions or comments, I guess. You spoke that you thought it should be around kind of 3.5, and you mentioned that that's, I don't know, let's call it a 25% margin then, that we're expecting. But for me, it's how quickly will it get there? Because if it's going to take 10 years, then is that a good investment choice to get that? Obviously, you'll be getting some form of interest payment from the bond by definition. But what are your thoughts on the speed at which? Because I think that's almost more important than the rate that it gets to.
Yeah, and I'm loath to talk about things that pension funds did that unwound during the times of Liz Truss, but it won't have escaped your notice that at the moment you could borrow against some of the cheaper bonds and reinvest them in the longs. Now, that wouldn't be something I would advocate doing. And of course, you'd still have to pay margin on those. So that may well not work. But you're quite right. We always need to look at time, because time is the biggest key. So I'm expecting this to right itself within the next 1 to 2 years, not the next 5 to 10. And I'm targeting that 3.5% sort of price within the next 2 years, certainly.
So you would look at, once it's down at that 3.5%, you go, right, okay, I'll probably sell out now.
I would. I think that'd be sensible to close at that stage, depending on where the momentum is. Yeah.
And I know we say it every time we mention buying UK gilts. How would you buy it? Would this be something you're buying in your ISA, or would you be buying this personally to get the capital gain sort of relief off that?
Yeah, really good question. You've kind of given me the answer in the question, which is very kind of you. But I would save my ISA allowance, limited though it is, generally speaking, for something else that was throwing off income. If you want REITs, for example, you're much better off keeping that sort of thing in an ISA because it's generating that level of income, assuming it's income generating units rather than accumulation style stuff. Because here I'm expecting to make the money from a capital gain in a movement of the price of the asset. So sure, for clarity, I'd be trying to buy something around 26-year 0.25% coupon as much as possible, because it's the coupons that are going to get taxed in that personal name, and the capital gain is not going to get taxed, because that's, and we have to say, of course, because by the time we do another one of these, we'll probably have had a budget apart from anything else, because that's slated for the 30th of October under current UK capital gains rules and exemptions. But I don't see the exemption on gilt being removed. I'd be surprised if that was tinkered with. But I guess I think on the 30th of October we probably will be surprised. So we probably need to be braced for something like that. But yeah, I'd be doing this in my personal name, not in a wrapper like that, as a general rule.
Right, Manish, any thoughts from your side?
The long end of the gilt yield curve, right? It's always a bit tricky because, you've got it's sensitive to interest rates to an extent, but it's really sensitive to long-term inflation projections. And it's also really kind of sensitive to what the pension funds are doing. So there's a bit of technical kind of distortions always. There's some liability matching, and the long-term pension funds will always try and get, hang on to long-term bonds because they need to, because of the regulations over the last 10, 15 years. So it's always hard to kind of work out. I mean, if Adam's right, and if interest rates, are on the way down, then yeah, you're going to get some capital gains on that. But I was just looking, when Adam was talking, I was looking at the sort of the UK yield curve in general. And, the 10-year yield is 3.9%. And right now the 30 year is 4.5. So if we do get that 30-year coming down to 3.5, that would be below the 10-year, but I'm guessing Adam also expects the 10-year to come down as well. So it's a tricky one. There's a lot of technical sort of aspects to this, really. And look, if ultimately, if you have a view that UK inflation is going to come down and stay down going forward, and so will UK interest rates by extension, then yeah, I think it makes sense to be buying UK bonds. Maybe other UK rate sensitives as well, but I won't kind of steal my own thunder, which I'm going to talk about later. But yeah, I agree. Then you need to be buying rate sensitives.
And is it just inflation then? Because obviously Adam was talking a lot about productivity, and that bringing down interest rates. But obviously we didn't really mention inflation within all that, because if you've got high inflation and low productivity, you've got a bit of a tricky situation. And it's not crazy to think that might happen over the next, I don't know, few years.
Can I just say something on that, Rod, in terms of my thinking? And my thinking is, and I think I certainly was guilty of missing this for probably the first 6 to 12 months of it happening, but I'm still not seeing it talked about more broadly in any of the financial press or anything really. But I do feel that very much what's been missed by economists as a rule and economic commentators is that the price of living, as in just the roof over your head, whether you rent or whether you own, has gone up dramatically. And that filter through the system has not yet worked. We haven't even hit the peak yet, let alone let that wash through the system. So the metric for looking at this is OOH, right? The owner occupier housing cost, which is produced by the ONS, which has hit 7% and has never been at 7% since March 1992, which was a pretty ropey time for inflation, but it's steadily been creeping up. We may have hit the top around there, but this is why people are able to get wage rises, or they have been able to, in the past few years of 10%, 8%, 6%, and it hasn't caused any kind of wage price spiral, because all of that is being sucked out, first of all, by the cost of the roof over the head, and consumption has still been falling. Now, we're going to now see government, in theory, we're now going to see government spending get cut in real terms in a number of departments. Rachel Reeves has laid out very, very low real terms increases for things like the NHS, which give her a completely impossible job, by the way. But, well, certainly we're streeting a completely impossible job. But if government spending is going to peak, stay the same roughly, consumption is suffering, savings have stayed quite high, this is very disinflationary behaviour. And as a real, someone who's waxed lyrical about inflation for 3.5 years now, I'm looking at the situation and saying, look, a lot of this is being soaked up by the shock absorbers. Rents will continue to be sticky. wages will continue to be relatively sticky, but they're not necessarily going to feed inflation, because higher rents, as they're currently working their way through the system and are carrying on charging on, are taking money out of people's pocket before we even get to disposable income or real disposable income levels. And that is a nuance, I think, or a bit more than a nuance, that I probably haven't. I'm a bit disappointed I didn't see that earlier on and start talking about it earlier, to be honest.
So
what do you guys think about that?
Well, I don't know, because I'm always of the opinion that there is a ceiling as to what percentage of someone's household income can be spent on a mortgage, repayments, or on rent. So I don't think it's good enough to say it will just keep going up, because I don't think it can, because I think people prioritize other things over it. And especially with a lot of the regulation as well, I think everyone will always prioritize food over shelter. And also there'll be some other things now that you can't get rid of someone if they're not paying very quickly. So I think they will go, well, actually, I'll kick that can down the road and put my money into something else that's needed. I totally agree on the disposable income, but I think the staples of living that people need to spend money on, that you're going to, I think there's a ceiling as to how much people, at what percentage of their household income can be spent on things. So I don't see it as kind of cut and dry as that, as to kind of go, well, that's going to take everyone's bit. I mean, to what point? I mean, is it going to go up to 70% of your income? Then that's fine if it's in London, because 30% is still a big old chunk. But if that's in, I don't know, the Outer Hebrides, it's not going to help. So
remember the national figures are still only sort of 28.5 as a general rule of gross income. And so traditionally in the provinces, we're scoring at about 33% affordability. Like you say, London works differently, but you've still got quite a lot of headroom. You've still got 20% headroom there. I'm not saying we're going to take all that headroom, but if wages are up 5.5 and rents are up 7, there's still plenty of room for that to continue.
I think we need to be careful of the context of some of these metrics, because when you look at, say, so you're talking about rents rather than mortgage payments, aren't you?
Yeah, generally speaking, yeah. But I mean, but our average household with a mortgage is earning double what the average household that rents is, as a rule, roughly.
Yeah. I appreciate that, but the problem you've got is there's normally it's normally families, and then sometimes you get people out of work, and then that contributes to lower levels of birth and all this sort of stuff. So I think housing is so complex and so integral to kind of everything else. I think there's still a lot in terms of a lot of these mortgage payments, because you've got to remember, a lot of the market that transacts is the market that has mortgages on them as well. So it's families growing and things like that. They're the ones that want to transact. And I think what you can find is that where typically we want to see more transactions and more mortgages and things like that, that's going to be eaten away and kind of really from down. So I don't know. I think it's really hard to kind of to call that, because I think there's kind of opposing forces there. But yeah, I was gonna ask something else about the political landscape and how you think that will affect on this, because you mentioned kind of Rachel Reeves has got this impossible task, and we're seeing all these things like I mean, obviously they've got to do tax cuts, even though they said they never would, and we were kind of seeing in all the news all these things coming out to describe kind of various different tax cuts that can come. But what are your thoughts in terms of the gilt yield then, with that political landscape and all these tax cuts that may or may not happen?
Well, it's probably fair to say, isn't it? That I think it would be fair to say the gilt yield has been more influenced by the skill of the or lack thereof of the Chancellor of the Exchequer and the Prime Minister than it has been for a number of years. I mean, it got very sensitive around the Liz Truss times because there were that you could feel the gilt market almost shouting, no, no, you can't do this. This is not acceptable behaviour, and we're going to show you, and we're going to punish you as a country. And I actually think part of the reason why I've said the 30-year as well is I think we're still suffering from that scenario in the longs, and the market that's been distorted by the Bank of England having to get involved. I also think it's still a bit distorted by quantitative tightening as it goes. And I'm thinking semi-politically, if I was Rachel Reeves, I'd be leaning on the Bank of England Monetary Policy Committee to say, stop selling bonds into the open market, because that's scheduled to cost another 30 odd billion quid over the coming years. And that will wipe out that black hole. And we actually find out about that in September's MPC meeting. So we'll see. So I think the credibility and skill of the Chancellor is key. I think Rachel Reeves is well thought of, but her first real test is because I think you will have a lot of people looking at her at the moment going, you shouldn't have made all these promises about taxes, because it stopped her from being able to turn around and say something like, do you know what? I think we should abolish national insurance for employees, but income tax is going to have to be 30% at the basic level, because then you could have, for example, pensioners who earn more money contributing towards social care, which is ultimately there to benefit them at the moment. That would be one way of changing things if you hadn't said that you weren't going to do those things already. So she's got a really tough task, actually, because if she's going to find this 22 billion, now some of this 22 billion is going to be found by the fact that the UK is growing faster than anybody's thought it would. But then you're down to the vagaries of the OBR growth forecasts, which people recently have said have been fairly bullish, but I mean, I don't think they have been. They haven't been as bullish as my growth forecasts have been. And it turns out that we've been the ones who've been correct over the past 6 months. So let's see, 2025 isn't necessarily more Goldilocks. We'll see. But if she does find that money in other ways, let's say, like influencing the QT program, or just getting a bit lucky with what the Bank of England decide to do, that will change things. Otherwise, if she's got to find 20 billion from fairly minority tax rises, she's going to be stuck with shafting people on IHT and stiffing people on pension contribution rebates, and anything else is going to make a billion of difference here or there, which, whilst I'm tossing those large numbers around with relatively significant abandon, it's not going to solve the problem that she's got. So pension reform on contributions, I'm expecting. CGT, she's got to be careful, because figures have already suggested the take could go down quite easily if CGT goes up. I mean, no one seems to have mentioned yet that if you put CGT at the same level as IHT, why would an old landlord sell an asset? There's no point. Just leave it in your estate till you die. There is no real tax advantage of selling it before that's the case. So you may as well just hold it till death. Of course, you might reform IHT as well, although I don't know if the threshold can really go down. It could be more about gifting, and I think things like, BPR and all the rest of it are probably in trouble as well. But politically, it relies on her staying in post, doesn't it, generally speaking? What could happen around 2028 or something? I hope we'll be out of this trade by then. Because if Labour haven't done a few things that they're going to need to, I think the next election could look really significantly different apart from anything else. But we've got plenty of masterminds to go before that one, my friend, so I'll leave that one to speculation for the future.
Any other comments from you, Manish?
No, I think in general, the whole going back to the Liz Truss kind of situation, in a way, it kind of helps Labour, because Labour now know they need to be more responsible. They know that they can. Labour now know, and it's kind of shown in, since Labour got in, the markets haven't really panicked, because the markets know and Labour know that governments can have an impact on the bond markets, as was seen in 2022, right? So you kind of have to. They know they have to be careful. And so in a way that kind of gives them more credibility, and that probably plays into the hands of Adam's trade, which is that actually the more credible governments are, the more responsible governments are, that's going to benefit the bond markets, and that's going to ultimately result in lower yields over the long term.
Brilliant. Okay.
That's the Manish seal of approval. Yes, I'm glad I went first now.
Manish, do you want to go? Because is yours?
Yeah.
on the same kind of wavelength, I think.
Yeah, kind of. Yeah, it is. Mine's a play on the fact that, policy rates, interest rates have peaked around the world. And actually, this is a play on US rates declining, but not significantly. But also, we're in a period where hopefully the economy remains stable. So I've gone for a REIT ETF. It's a global REIT ETF. It's the HSBC NA REIT developed ETF, and the ticker is HPRS, listed in London. So it's an ETF of REITs. It consists of kind of multi sectors, so commercial, logistics. It's got some tower infrastructure holdings, all of those kind of things. Predominantly in the US, so it's about 64% US REITs, and there's a bit of Japan, a bit of Australia, a bit of UK. And it's just a globally diversified REIT, which hopefully should benefit as rates just continue to come down steadily from here. The dividend yield is not huge. It's about 3.5%, but mainly because it's got so much exposure to the US, which generally pays a lower dividend yield. In 2024, this year, it's done around 2%, which isn't much. Over the last 12 months, it's up around 14%, 15%. The other thing I like about it, it still trades at a discount to NAV, around 10% discount to NAV. So I was kind of looking for rate sensitives. There's a lot of rate sensitives out there. We picked one last time round, which was a sort of mid-cap, small-cap play. I think all three of us had a mid-cap bias to our picks last time round, which have done quite well. Again, this is a rate sensitive. I was looking at other things like gold, miners, etc., which kind of play into a similar theme. But yeah, I think this one has got mileage to go from here. I'd put this on a sort of 6 to 12 month play from here.
Brilliant. I mean, I like that idea, and I totally understand it. Why would you do that? What are the reasons for you to invest in something like that rather than directly investing in more property if you feel that's the way it's going?
So this is a purer play on rates. I mean, in property by bricks and mortar, you mean, Rod, right?
Yeah. Because I know you buy property as well. So
yeah,
I'd like to understand that kind of thought process, really.
Yeah. I guess I'm more bullish on property as a sector compared to property for investors. So what do I mean by that? So when I look at property for investors, there's all sorts of noise right now, with what's being proposed. So CGT reforms and rent controls and all of those things. So buying property as an asset class isn't the same as investing in property as an investor, because as an investor, you've got all these potential other uncertainties, which may or may not come to anything. But, so that makes me a little bit nervous investing in bricks and mortar. Whereas if I look at end values of property, whether it's residential, commercial, etc., they're going to be more influenced by kind of, rates, interest rates, etc., which is why I kind of like the REIT space more. The other benefit of buying a REIT, and this is a REIT ETF, the other benefit is you can stick it in your ISA or in your pension, and it's completely tax-free. Whereas, if you buy bricks and mortar, you've got those tax liabilities you're looking at as well. So it's a more efficient way of playing property, in my view.
Yeah, absolutely. I don't disagree with any of that. One point you said was it's trading 10% below NAV, so net asset value, which is always something kind of I'll look for. But one of the caveats to that is how they calculate net asset value, because that's the stickler, isn't it? It's all well and good saying something's below it, but until you realise, well, how are you actually calculating that? Because that's come up in the past, and it's been a little bit of a trap, because suddenly you buy it because you think, oh great, it's trading at 10% under the NAV, and then suddenly the NAV is recalculated the next week, and turns out it's not trading below. Any thoughts?
No, it's a great question, and I'm aware of that. And you do get those kind of, especially with individual REITs, and they're sort of the way their valuations are calculated, different policies, different surveyors, etc. What this is, you know, because it's a REIT ETF, it's got something like 150 different holdings. So you're not kind of beholden to one particular way of valuing it. And look, historically, this is traded on a premium to NAV. So I'd rather be buying at a discount than a premium. But I agree, you know, that is a watch point. That often those kind of valuation discrepancies often happen during turning points when interest rates are changing a lot. You know, it's the way the valuations take interest rates into account, discounted cash flow, etc., which tends to be a bigger issue. When times are stable, when interest rates are on a more steadier path, that becomes less of an issue. But it's still there. And I guess the answer to that question is I'd rather be buying at a discount than a premium. But, you know, you do take these discounts with a slight pinch of salt sometimes. I agree.
And in terms of the kind of share price then, it's currently, I think its year high was £20.07, and it's currently at £20.04. So it's trading at its kind of highest in the 12 months. Any concerns over that?
Well, it's funny because it started off the year strong, 2024 quite strong. Then it had a bit of a dip, and then it's made a round trip back to kind of level. So if you look at 2024, it's kind of moved sideways.
Yeah.
It's from the absolute lows. I think it was October, November last year. It's had a good run, but remember that was a pretty steep decline.
It was a short, sharp decline, and then
short, sharp decline. Yeah, so it kind of depends on how you look at it. I mean, it's still down. I'm looking at the chart here. It's still down on a sort of 2-3 year basis, you know, from where it started off. So yeah, look, it hasn't done much this year. It's still got a bit of scope for recovery. I think I'd be putting this on a sort of 20-25% target price, and then looking to kind of move out from there, which wouldn't make it look too expensive because it's got a decent yield. You know, if you look at the dividend yield compared to treasury yields, for example, it's still trading at a nice premium to regular sort of treasury yield. So yeah, from that point of view, I think it's got a good 20% from here.
Okay, so that was my next question: is when would you be selling out? Because I think you mentioned sort of 6 to 12 months you'd be looking at it, but are you kind of looking at and expecting that 20% in the next 6 to 12 months? Or
yeah, I think so because, you know, when you see rate sensitives like this, they kind of they start to do well when interest rates are beginning to get cut. And remember, in the US they haven't started to get cut yet. In the UK we've had one, but we're at the very early stages of the rate cutting cycle. So I guess when we're sort of 1/3 to 1/2 the way through the rate cutting cycle, that would probably be the time where you start looking and think, okay, well, a lot of the good news is in the price, and you know, we've got some more rate cuts ahead of us, but not too many. So I think I'd probably look at 6 to 12 months as a time frame for maybe looking to move on and moving on to something else. And look, if we get that 20-25% before then, I'd be very happy to take profits and move on before then.
yeah, brilliant. Okay, really interesting. Adam, any thoughts on that?
I love the time frames, particularly that's been put together. I love the idea of waiting until the good news is in the price. I was talking to someone earlier on today, you know, that old adage of buy the rumor, sell the news, or sell the fact, depending on you who you think said it in the first place. I really like that. I think the comments about NAV, generally speaking, are spot on. I also think probably maybe the only thing you guys didn't say is that when the discount, I'm much happier. This might sound a bit silly, but I'm much happier with a discount to NAV of 10% than I am of 40%, because 40% definitely means we're so far overdue a revaluation, or we're actually skirting around bankruptcy or something like that. Whereas a bit of genuine discount like that, especially if you're happy with the underlyings, or going back to what Manish finished off his commentary with there, the news, generally speaking, has been priced in. The bad news has pretty much fully been priced in by now. So we're comfortable. If there's still a discount to NAV, a 10% today might be a lot better than a 25% in October 2022, to pick a month at random when we may or may not have been suffering with the after effects of a disastrous mini budget. So I like the pick overall. I like the logic. We are close-ish in what we're thinking is going to happen. And as usual, I expect Manish's superior skill to mean he does better than I do on the basis of what we've chosen to reflect it. But yeah, I can't really fault it at the moment. We're pretty much on the same page. The rate sensitives, absolutely. That's really what we're punting here, isn't it? And I'm on that bus, Rod. Absolutely.
Brilliant. Okay, so moving on to my pick then. So this one was brought to my attention where the Berkshire Hathaway kind of released their filings on what they bought and sold.
Are you using a saucer here, Rod? Can we be clear?
And this one caught my eye because I'd never heard of it. And when I read about it, I thought, what the hell is that? That just sounds ridiculous. So I'm going to explain it. So it is Liberty Media with the ticker LSXMA. And they are doing a merger next month with a company called SiriusXM Holdings. So these are both on the NASDAQ. And really what's happened is Berkshire Hathaway have been buying a load of this stuff for the last 2 quarters. And what it is Sirius, what they do is they are essentially a satellite radio company. And so it's for people like listening into Heart FM in the car, but it's all done by satellite. And instead of raising all their revenues from ads, they raise all their revenues from subscribers. So initially I thought, well, hold on, radio's dead. No one bloody listens to radio anymore and all that kind of sort of stuff. But they have over 33 million subscribers at the moment in their total companies with Liberty and all their satellite subscribers, because there's a few other things they do, like they've got a company called Pandora, which it also owns, which is like a streaming service as well. So they've got over 150 million subscribers or listeners across the board. They've got great free cash flow. They're trading at the lowest PE that they've had in 7 years, which is about 8, I think. They're trading at a really good price to sales. They make very big margins. They've got great free cash flow. They do have quite a bit of debt, but that doesn't seem to be hindering. It's all long-term debt, and it doesn't seem to be hindering the cash flows at all. The stock price in Sirius has dropped over 40% this year, which is probably why the PE looks so good now. There's no ads on the radio. It's got net income has increased by 316 million this year this quarter, and that's because they've been focusing on cutting costs. So their revenues declined by 3%. But they've reduced all their overheads massively. Their EBITDA is up 8%. So they're giving a dividend of about 3.8% as well. So this was kind of, like I said, brought to my attention because like Berkshire Hathaway bought it. So I thought, oh, right, they know what they're doing. But I hate the idea of buying something because someone else says it's good. So I wanted to kind of look in and go, oh, well, he knows what he's doing. Let's do that, because that's not always correct, is it? So I wanted to understand the reasoning behind it. And when I actually delved into it, it does look like a typical value play, which is throwing off a load of cash, and there's upside coming. So because of this merger, what they've been looking at is Liberty Media is a holding company for lots of different kind of media outlets. So they've seen the value in it. They're looking to buy this satellite program because actually they started using a lot more tech, and they're innovating, and they're looking at how they can increase listeners, increase subscribers. And so, yeah, I thought it's a really interesting one. So like to hear what you don't like or do like about it.
Well, I know a bit about Sirius just because of Howard Stern, and actually been involved in an internet radio company that tried to take a similar concept to the UK. So I've been an admirer of the company for some time. What I love about this pick is that if you listen to a whole number of Bill Ackman podcasts, let's say, This is exactly the sort of rhetoric that goes behind it. And what I hear behind all of that, which is a great story, is look at the drop in the value and where we're picking this stock up cheap. And, he's someone who's managed to do that with unthinkable companies like Google, for example. And you did a similar thing, Rod. I guess it's a couple of years ago now when we were talking about Meta, buying into a really established, strong, still growing at a comparatively low PE or a comparatively low sounding PE. So there's a bit of Howard Stern, not dependency, but he's a significant character. And I guess he's probably 75 or something these days. So he's just about old enough to be running for president pretty soon, apart from anything else. But I guess I'm not overly worried about that. There's obviously much more to it. It's much, much broader than it is Howard Stern. And I think the business model is great. I think you're possibly thinking there might be some merger arbitrage in here when it comes to the value and all the rest of it. Certainly Warren's probably thinking along that road. And I think that probably gives it a pretty good boost where it needs to. But I love the idea of stock price down 40%. So buy the company that's buying a bargain. I mean, there's just enough nuance in that to escape most analysts in the market. And thanks to Uncle Warren for giving you a tip to discover it further, is what I'd say. So I wish you all the best with it.
Manish?
I think on the positives, look, if Uncle Warren is buying this, look, that's as good as validation as you can get, right? So he obviously knows something the rest of the market doesn't, because if something's trading that cheap and he's buying, there's definitely something in this. Quite possibly, he hasn't got his track record is good, but he doesn't get everything right. Exactly. So that's one thing to bear in mind. You mentioned it's got a PE. I was just looking at it whilst you were talking, and actually, if you look at its forward PE, it's even cheaper. It's like 6.5 times on a forward price to earnings ratio. So that's even better. So those are two things. It's a value play. Warren Buffett is buying it. There's a possible turnaround with this merger going on, which is great. My only negative that its revenues have been declining over the years, right? So we kind of go back to 2021. What is this? 8.9 billion. Yeah, 8.9 billion. Then it's kind of been flatlining. So the revenues haven't grown, which is a slight disappointment. But I guess that's what explains why the PE is so low, and that's probably what explains why they're looking to kind of merge with another company and look for ways to grow its business. And if that comes off, then yeah, look, you've got low valuation. Warren Buffett's behind it. That would be a springboard for this company and the share price to really take off. But that's the key thing. This company needs to turn around because the historical revenues have been kind of flatlining at best.
Yeah, so revenues, you're right. They have kind of stayed pretty stagnant, but where it started to kind of really up the ante on the net income is just they've doing a massive cost-cutting exercise for this year. So they're on track over the first 2 quarters, and it looks like they're going to save another 200 million by the end of 2024. And yeah, you're right in terms. Well, the revenues that they're getting at the moment from subscribers, their subscriber base seems incredibly loyal. But you're right in that they don't seem to be picking up extra, which is where the whole Pandora thing is coming in, and why I think Liberty Media are coming in, because that gives them this holistic approach to media, which I think should only help it really. Competitors wise, you're looking at kind of the likes of Spotify, Apple iTunes as well. But I think they're looking at a bit more innovation around the sides. And because from what it seems like is people go, once you listen to satellite radio, you never listen to sort of the other radios again, because the sound quality is better, there's no ads, and you get everything kind of you need. So that seems to be what most people are saying about it. But yeah, absolutely. It would be great if there was kind of this very clear path to upping the revenue. But it's kind of what we're hearing is there's these kind of relationships building, which sound like they could lead to something, but we're not quite sure what they're leading to. So
Yeah.
that's kind of the bonus at the end. But in the meantime, it's a value play.
Yeah. Yeah. So I do like it. I mean, look, I think every portfolio needs a value element to it, right? Because right now, if you look at the sort of global diversified portfolios, they're quite sort of you're probably focused on tech and more expensive stocks, and value's almost kind of gone out of fashion. It still is, right? So we every now and then between us, on these masterminds, we try and punt value, and sometimes it works out. But over the long term, if you look over the last 10, 20 years, it hasn't really done much. But I think, when value does go, it really comes back in a big way. So look, I think every portfolio needs some sort of turnaround story like this.
Brilliant. Well, I think that brings us to the end of this quarter's mastermind. So thanks, gents, very much. And look forward to seeing you in about 3 months' time to see how these picks have gone and whether we're all ISA millionaires by that point. So until then, thanks very much, and hope to see you again then.
See you soon.
Cheers.
Thanks, everyone.
Click record, sorry.